Hey everyone, Anthony Venuta here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about variable rate mortgages, major differences that you may or may not be aware of, and why and how not to get triggered. Stay tuned, you don't want to miss this. Once again, we want to take this opportunity to continuously thank all our supporters and viewers of the channel. For everyone joining us on Finance Fridays, we thank you, and please leave your comments in the comments section below. Don't forget to hit the share, like, and subscribe button. Hit that notification bell so you're notified every single time we post a new video. And do us a favor, if you like the content that we are providing, please feel free to share this video. Now, back to our video. Not all variable rate mortgages are created equal, and on this episode, we're going to break down some of the major differences between variable rate mortgages that actually have a payment that changes and those who do not have payments that change, and what you should be paying attention to in each one of those products. So a lot of Canadians were getting phone calls and emails and DMs from our social media, as well as referrals from other clients who have banked with other institutions who are not sure, or maybe were not explained some of the major differences between the two products, as well as what is happening if the Bank of Canada on July 13th increases 75 basis points. So the major reason we're doing this video is because as a lot of Canadians are starting to sweat a little bit more ahead of July 13th with a 75 basis point increase looming, that could mean a substantial amount of money per month per client, depending on their mortgage size and the type of mortgage that they have. So if you find yourself in an adjustable rate mortgage where your payments change with the Bank of Canada policy rate, as well as your lender's prime rate, 75 basis point can be a big jump. And we'll talk about a little bit about those payments in an illustration a little later on in the video. If you have a variable rate mortgage where your payments remain fixed, a lot of clients liked this product when they maybe explained it to them. Maybe they weren't fully aware of it. But obviously, depending on when you got this mortgage or when you initiated it, it seemed like a very attractive product. And it still is for many Canadians on a tight budget who wanted an aggressive rate. And most importantly, depending if they were put in that product because of their journey or their home ownership structure, maybe they were looking to sell sooner, maybe they were looking to refinance quicker, and they didn't want to stay in a 5-year product, they chose the variable. Obviously, over the last few months, we've seen the entire industry change from real estate to mortgage qualifications, and now more and more questions are coming up about the variable rate products and what we should be looking at going forward. And the most important thing that I've noticed with variable rate mortgage holders is they are not 100% sure on if they are in one of the two buckets, adjustable or fixed rate payment. Now, although this may seem like a simple solution, we always tell our clients the best way to look at it is two things. Has your mortgage payment changed over the last few months when the Bank of Canada increased its policy rate and its prime lending rate? If the answer is no, most likely you are in this type of bucket where your mortgage payments are not changing. And therefore, we would advise our clients to take a look at a few things. I'd say, dig up that old mortgage statement and take a look at, where exactly your trigger rate clause is. And if it's not on there, maybe reach out to that institution and find out exactly what your trigger rate is for your particular mortgage, because it is all dependent on exactly what type of discount you have on the variable rate product. So, for example, in this particular scenario, this client's trigger rate is at 4.59%. And that's because they have a discount, a significant discount. And that was the trigger rate that was set. And it was clearly indicated in the client's documentation that they received following the mortgage closing. The client was explained basically how a trigger rate works. And here at In Touch Mortgage Solutions, we get our clients to sign disclosures and understand exactly that it was explained to them. But a lot of times we're hearing from clients that they don't. They had no idea. Because once triggered, payments adjust to cover the interest, since your interest payments no longer cover the interest charges, and therefore the payments will reset to the trigger rate. So for many Canadians who might be in the 3% and the trigger rate might be at 4.5%, you may not be aware that that payment will basically go up significantly when you were maybe advised that your payments were going to remain the same. So understanding the differences between that and how that could impact you is basically why I've created this little chart here, and we're going to dive right into it. So here I've created a trigger rate sheet, and what you can do right now is maybe take a snapshot of this screen so that maybe when you find your trigger rate or you know your trigger rate, what you need to see happen with the Bank of Canada and what needs to happen with the rates in order for you to get to that point. So this can help you make a decision of gauging how much time we have. It takes a little bit of, hypothesis. We don't know exactly what's going to happen with the Bank of Canada, but at least you can be better prepared and armed with that information and see exactly where you are. So for example, if you're situated here and let's say we were talking with our client and their interest trigger rate was around 4.59%, they're at prime minus 1.27. So it's in between the 1.30, 1.27. 4.5, that means the Bank of Canada would have to increase it by their policy rate by 2%, bringing the overnight policy rate to 3.50%. So right now the Bank of Canada policy rate is 1.5, prime is at 3.7. And you'll notice here, this is the prime minus tab, this little column here. And then you just basically move across depending where you are in your mortgage, and you can see what would have to happen to the Bank of Canada policy rate in order for that trigger rate to be impacted. So once again, don't forget, take a little snapshot of this if you are going to look at your trigger rates and see exactly what has to happen with the Bank of Canada in order for your trigger rate to be impacted. Now, another thing you can do to couple with this chart is once you know the trigger rate and you'll see exactly what those payments are, we have included a link in the description box below to our Canadian mortgage app where you can download for free. And you can go and click on the basic simple mortgage calculations. And there you can play with different scenarios. You can also look at the different amortizations. You can look at the different rates, keeping that payment the same and seeing how interest and principals amounts will different from, rate to policy rate and different from, your trigger rate. So it gives you a whole bunch of numbers that you can play with and give yourself a little bit of, understanding of where your payments could be. So it helps you budget more depending on that particular product. Another key component to the trigger rate obviously is when the interest rate goes up and your interest payments are not covering. That's why the bank is triggering that actual clause to make sure that you're covering the interest payments. But a lot of Canadians are not aware that there's another side effect to this type of product, especially in rising interest rate environments. And that could be depending on where you are in the journey of your mortgage. If you just got it and you're paying monthly and you haven't done any lump sum payments, and the amortization may go into a negative scenario where you started off at 30 years, and if you don't hit the trigger, you do hit the trigger rate, where is it going to bring that amortization to? Because you can go from 30 to 32, 33, 34 years, depending on how long it takes for that trigger rate to kick before it comes back down again. Obviously, it depends on your actual institution, it depends on that trigger rate, and it depends on what timeline you have been in your mortgage for, what that discount is. So obviously there are a few things to be aware of. And the reason that it's important to understand that, especially for clients who have this product, is also for clients who are going to get into a variable rate mortgage. Maybe they have one coming up. Maybe they bought something and they're closing and they're not sure exactly. They were told variable is the best way to go, but they don't know exactly which product they have. Maybe they weren't explained this. So ask yourself or ask your broker or your institution how their variable rate products work. Now, if you flip this over to the other side, which is the adjustable rate product, that's the product that I actually have. And for most Canadians, they're maybe not aware that, as I said, there's only two banks in the top space that offer the adjustable product from our research, and that is Scotiabank and HSBC. And obviously on the broker side, there's a few mono banks, mono lenders that are accessible through brokers that also change their payments that are adjustable. Let us know in the comment section below which banks you have that are actually adjustable that maybe we haven't mentioned. So let us know in the comment section below. But it's important to understand that if you're in this type of product, obviously you need to be able to absorb the payment differences per month. And I've just created like a little chart with a little illustration to highlight some of those changes. So here you'll notice the adjustable rate example. I've used the $500,000 mortgage with a 30-year amortization. Obviously, we're taking this into consideration with this particular example. Obviously, you can do this for your own. You can download our app, as I mentioned, and play around with these. And I've used the prime rate of 3.70. So as of today, obviously, if you had a $500,000 mortgage with a discount of 50 basis points, your mortgage payment would be around $2,156.56. I've highlighted in yellow a potential increase of 75 basis points and still continuing along that discount of 0.5%, where it brings your rate to 3.95. And now you'll notice your payment jumps up $206.91. And subsequently, what I've done is I've taken, the hypothesis that after the 75, maybe we're going to see 50. Let us know in the comment section below what you think about that. But obviously, just for the sake of this illustration and this chart, just to give an idea, the two differences, and one, your payments stay the same, one, your payments are changing, how that will impact your payments. And obviously at the bottom here, what I've done is I've illustrated where the current 5-year posted fixed rate is, and how that payment is actually $571.89. And basically, if you tally up these amounts, you're just shy of that. So obviously we would have to see a very significant run up in rates in order to be at the current fixed rate. But as I mentioned in other videos, that is a decision that you need to make on whether or not to lock into a fixed or stay in your variable rate mortgage. I just really wanted to illustrate, for the sake of argument, the differences between the two, because going up in payments slowly is sort of, you're bleeding out that money per month on an adjustable rate product. Yes, it's not exactly the most desired, but as you're paying up that mortgage up front, each and every time the Bank of Canada makes these changes and prime is changed with your bank and you get those notices, basically your amortization doesn't change. So the duration of which you're supposed to have that mortgage, the balance at maturity, everything remains the same, as opposed to the other side where your payments basically don't cover the interest and your amortization may go into, a negative position. Those are things to understand. There's definitely pros and cons to each side, depending on your affordability, your budget, your financing, where you are in your mortgage, and what's important to you. Choosing between these two types of products is important, but understanding the two types of products is probably the most important. Now, obviously, if you have questions about adjustable rates or variable rates with fixed payments, reach out to us here at In Touch Mortgage Solutions. We'd be more than happy to help you and explain a little bit more about it. Don't forget to download our app in the description box below so that you can have some fun playing around with some of those payments and see exactly where things will end up, depending on where you see things happening with the Bank of Canada. Let us know in the comment section below what you think about July 13th. Will the Bank of Canada raise its 75 basis points like the US, or are we going to see more, or are we going to see less? So I'll leave the video here. I hope you found it very interesting. And if you have any questions, always feel free to reach out to us. We'll wish everyone a happy long weekend, as it is Canada Day weekend. So happy Canada Day, and we'll see everyone next week. Thank you for tuning in. Have a great weekend.